Hello and welcome to Switzer TV Investing. I'm Peter Switzer. And just when we thought tech stocks were on the nose, Zip was up over 4% today, Tyro 2.6%, and Afterpay up 5% plus. In early September, Apple peaked around $134 and recently slumped to $107. Since then, it's gone to $112. But is this stock, along with the likes of Afterpay, just having a breather before taking off again? Paul Rickard will look at Apple in particular, along with some other tech stocks locally. Meanwhile, Adam Dawes of Shaw & Partners will evaluate Treasury Wine Estates, AGL and Soul Patts. Are these buys or sells? Next, we'll catch up with the CEO of McPherson Limited, which has been on a nice 5-year rise. But the question is, can this company keep impressing the market? I suspect so. Then Julia Lee will look at her latest acquisitions for a fund, as well as give her views on Brainchip Holdings, Nearmap, Origin Energy and Vocus Group. And then we get two special views from Mark Bouris about the future of the banks and the threat of fintech banks. So that's the show. Let's kick off with Julia Lee from Berman Invest. Joining us as she does each Monday is Julia Lee from Berman Invest. Thanks for coming on the program, Julia.
Pleasure, Pete.
Okay, let's just go into a lot of these sort of questions we received at the Boom, Doom and Zoom show, and we'll get some of your recent likings or dislikings when it comes to the market. Have you got a view on Brainchip?
It's a good question. Look, this is a stock with a lot of hype around it, and I like stocks with a lot of hype around it. You just have to be wary, because I guess when you're in the stock, there is an element of herding involved where everybody gets excited about the stock, valuations go through the roof. So generally the way I approach stocks like this is I'm happy to jump on with the herd, but I want to be the first one out of the exits when the turn comes. So whether that's on fundamental or technical news, I tend to track both. And look, at the moment, technically, it's not looking that great at the moment.
Okay. Now, Julia, Nearmap has an SPP, and we're asked about what you might think of Nearmap and the SPP.
Look, I think Nearmaps is a bit more risk involved now, given that it has promised that it will get to cash flow positive a couple of times now. So there's an element of trust from the market, but it's also got to rebuild its reputation. If you are willing to take a bit of risk earlier on, though, I guess Nearmap would be more of a speculative play. One of the things that I do like is the roofing business that it recently acquired. It's a big growth area where it automatically works out the size of roofs, which is great in terms of growth as well as the solar industry. And look, it's also implementing AI-driven strategies, which I think will be a strong area of growth. So it's not only about its products, but it's all about the data as well. So look, if I was putting some money into Nearmaps here, I'd only start off with a little bit, because I do think it has a bit more reputation building to do in the investment community.
Okay. Origin and AGL, what do you think of those two companies?
Look, I guess in terms of Origin and AGL, both of them are dependent on power prices, which have been relatively weak. I mean, you only have to look at the oil price. So look, the big turning point for these type of companies will be when the oil price rallies. AGL in particular, we have seen a downgrade in terms of its shares. And look, a couple of its electricity supply contracts to smelters, one in New South Wales, one in Victoria, is under a big question mark. So that brings in a bit of uncertainty in terms of the stock. I guess with companies like this, I'd be asking myself, where is the bottom? Where has earnings growth really bottomed out? And I think for these type of companies, it will be an FY22 story, which means there's no real near-term catalyst unless we start to see the oil price start to run. As with anything, when you do see an industry which is politically sensitive like energy, watch your political moves as well, because of course if you do see a cap on electricity or power prices, that would be a negative for a company like this. But I think the main turnaround for these type of companies is going to come from an increase in power prices. So watching the oil price carefully.
Okay, here's a company that's been a disappointer over the years, Vocus Group. What's your view on them now?
Look, I think Vocus has been doing well. Recently, we heard from the company, and Vocus Network Services has been a key core driver of growth. So that has been performing strongly. And I guess when it does come to networks, what you want is speed as well as security. And Vocus is doing relatively well in that area, as well as its direct connection to Asia. Look, Vocus is looking okay here, but the stock I prefer in the sector is Telstra, given where the share price is trading at the moment, and given that we are likely to see iPhone with 5G capability being announced by Apple in October. So I think that's going to be a key driver of the first suite of products related to 5G, which might give Telstra a bit more of an advantage over some of the other telecom companies out there.
Okay, this is a company that you often talk about, namely Charter Hall CLW. Now they're doing a share purchase plan at $4.80. Do you think it's worth it?
Yeah, so Charter Hall Wales is doing a share purchase plan. It's raising capital. And I guess when a company is raising capital, it's important to figure out why it's raising capital. Does it need working capital? Is it trying to shore up its balance sheet? Is it trying to pay off debt? For Charter Hall Wales, it's none of those things. It's making an acquisition of a portfolio of BP service stations. And that's going to also increase the yield that it gets from its portfolio. So the thing I like about Charter Hall Wales is that it is a long lease portfolio. So the weighted average lease expiry is at around about 14 years. So there's a lot of stability in terms of the cash flow. The last result, we actually saw an asset revaluation, which was positive. But with all capital raisings, you sort of have to check out where the share price is at the time that the due date is, and I believe the share purchase plan is at $4.80, whereas Charter Hall Wales is trading at about $5.20. It does go ex-dividend tomorrow, which means that the share price will probably drop back down to around the $5 mark, but still, you know, if the stocks are trading at $5 on market and you can pick them up at $4.80 through the share purchase plan, I guess obviously you would. The only time you wouldn't do it is if the share price was trading below that share purchase plan price.
Yep. Good point. Now, what about Reece?
Yeah, this is an interesting one. This is Australia's largest supplier of plumbing products as well as bathroom products. And during COVID-19, it looks like a lot of us have been renovating our homes. So the renovation market has come to life. So initially the views on Reece was that during COVID-19 that we would see declining sales. But really what we saw there, it was quite resilient sales coming through. In fact, sales increasing. And it's not just the Australian story that's exciting here, it's the US story. And the US housing market has been much stronger than here in Australia. And in fact, in the second half of the year, we actually saw like-for-like sales from the US up by 5%. So really with Reece, it depends on whether you think that renovation market is going to continue to grow. My view is that we will continue to see strength over the next 12 to 18 months, driven by some of the government incentives that are out there. Some of the brokers are getting cautious around where the share price is, given that it is trading at a premium. My view is that that premium is because of the expected growth coming from the market. So look, I'd be happy to own Reece at these prices. I'd become cautious if they weren't able to deliver on growth. I noticed that BIS Economics predicts that the renovation market is going to grow by 9.5% over the next 12 months. So as long as that growth comes through, I'd be pretty happy holding it here.
Yeah, I think when people renovate, they invariably end up with a Reece product. Finally, MPL, Medibank, what do you think?
Yeah, this is an unusual one. I mean, looking at Medibank Private, when you're looking at an insurer, the type of things that you usually evaluate are, of course, the premiums, the claims, as well as the investment part of the portfolio. So I guess having a look at Medibank Private, in terms of the premiums, well, some of that has been on hold because of the COVID-19 environment. And I guess looking forward, it depends on if the unemployment rate does go up and people are struggling financially and maybe cancelling their private health insurance. So a lot of that's going to depend on the unemployment rate. But from October, we will see premiums increasing. So that should be a short-term positive for Medibank. In terms of claims, it's also an interesting environment. You think that because of lockdowns that there would be less claims. In the area of hospital claims, though, we saw it increase by around about 3%, and that was due to medical devices. And my view is that even if claims are weak in the COVID-19 environment, that what you'll probably see in this area is payback, because when it comes to medical expenses, you can't put it off forever. So what you probably see in the following following year and the year after that is higher claims coming through because of a payback and people not being able to access health services. So I actually see a deteriorating claims environment over the next 18 months. And in investments, look, the investments component has been relatively weak. So look, the only positive that's emerged here for me recently is the price rises that's going to come from the premiums, but I still see as the risks being too high, even with the share price declines. Look, I would prefer to see a little bit more of a turnaround, but if you are willing to take a bit more risk, the price here is looking relatively low. So you might want to put a little bit of money in and to see if the environment for medical insurers does turn the corner.
Okay, now before we go, a lot of people are giving you a thumbs up because of Mesoblast. What's your latest? What's your?
You know I love Mesoblast.
No. What's your latest take?
It's been a roll to ride, to tell you the truth, Pete. And sometimes with these biotech companies, you do need to have a huge amount of faith that they are going to come through. And look, the countdown is on. Only 2 more days to that deadline for the Food and Drug Administration to make their decision on whether they are going to approve Ryoncil for acute graft versus host in children. Given the Oncology Committee voted 9-1 in favour, I do think that it is going to get the green light. There might have to be some extra studies which are done on the back of the green light being taken, but I think it will be a momentous occasion for Mesoblast. Obviously, I say that given that we hold it in the portfolio.
Yeah, and on what day will we actually get the news?
So it's Wednesday US time, so it could be Thursday for the Aussie share market, which means that we'll roll over into a new month, so in October.
So on that day, you're going to have a lot more fans or a few people saying, how could she have got that so wrong?
Well, it's my birthday month, so hopefully it will be an early birthday present.
Great stuff. Thanks for joining us, Julia.
Thanks, Pete.
That's Julia Lee of Burn Invest.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, joining us now is Adam Dawes from Shaw & Partners. Adam, how are you?
Yeah, really well, thanks, Peter. Yourself?
Very good. Now, the market was up but ended in negative territory. Why?
It's a tough one, isn't it? It is very. Yeah, I think we came in with a little bit of optimism from the weekend, thinking that we were going to do quite well, and the banks didn't really follow through today. So, we really need those banks to do the heavy lifting, and it didn't come through. So, yeah, it's been a little bit tough for our market today.
Okay, but the tech stocks have done okay.
Tech stocks did well. Afterpay was up. I think I saw WiseTech off a little bit, but yeah. Look, the tech stock's starting to rebound back, and one of my favourites, Zip, is reporting a quarterly number this week. So I think that it's certainly going to be looking forward to some good numbers there. And we're starting to see some good little IPOs starting to come out in that fintech space as well. So Australia's market is starting to hot up in that space. Okay,
let's go to something you want to talk about, Soul Patts. What's your thoughts?
Yeah, look, what a great result it was the other day, last week, with Soul Patts. Able, one, to increase the dividend, and I think that's the biggest thing that we've seen going forward from Soul's is their commitment to lifting those dividends, and obviously they were able to do that via the TPG Vodafone merger, which they own, I think, around 26% of that business, and they were able to do that via a nice special dividend. But I really like Soul Patts. It's one of those ones that is just a consistent earner. It's a good dividend paying stock compared to something like the banks or something like that, and really. At the end of the day, they're a good little investment house to be going for. So I like the stock around this $22, $23 mark. It'll probably do some work, pay the dividend, and then potentially start raising from there.
Interesting thing is some people question the fact that the Milner family has such a strong presence that there's a feeling that they're not quite sure what's going on. What's your view on the transparency of Soul Patts?
Look, it's an investment business or an investment bank, and it is a listed company. So there has to be some kind of transparency there. And we do know a lot of their assets that they do hold. But you're right, albeit there's probably the top 10. We don't really know what's really underneath the cover on that. But the family has done very, very well over the years. They have done very well for shareholders and have basically held true to what the business is about. And they are, they're not private equity, but, and they're not a Wesfarmers because, Wesfarmers $10 billion sitting in the war chest ready to go. But I think Soul's are very, very, very good at what they do.
Yep, yeah, I think you're right. So let's have a look at Treasury Wine Estates at the current price.
I think there's value there. Tell me if I'm wrong, Peter, but I think there's value there. All we need to do is get over this China issue. And if that Chinese issue does go away, which potentially in the next coming couple of weeks / month, the Chinese government is going to make a determination on the tariffs that are going to be paid or that Australian wine is potentially going to have to pay when they start moving wine into China. But once that's over and done with, markets don't like uncertainty, and that will be the certainty that it's needed. So I think there's value there. That Penfolds brand is absolutely one top-notch, and I really like it for that potential divestment of Penfolds from TWE. So, look, I think it's a buy down here. You need to obviously potentially have some more volatility around this decision-making from China. But once that goes through, I think there's value and it's certainly a good business. Now,
you've also suggested that maybe it's a takeover target for Wesfarmers?
Look,
it's an interesting one. It's a good question.
Anything to grab a headline, huh? Look, potentially we've seen worse, I guess, Coles from Wesfarmers many years ago. But look, it's one of those things that I don't know why Wesfarmers has taken so long to buy some of these businesses when March 23 we had some amazing bargains and discounts. You know that Wesfarmers is always on the hunt for acquisition. So I was just, maybe potentially it is one of those stocks that hasn't risen with the rest of the market, and potentially that might be something that Wesfarmers might look at.
So this is an Adam Dawes speculator. You haven't heard any whispers?
No, I wouldn't be able to tell you anyway if I did.
Okay.
So, this is just me trying to make some sense out of this business.
Okay, AGL, a lot of people ask us about this. It's at a 52-week low. Do you think it's a buy?
No, is probably my answer. I still think that there's a lot to go on AGL. One of the things that AGL and Origin talk about is leakage. And the leakage is basically more and more people being energy conscious, but then also putting solar panels on their roofs, and that is just a trend that is going to continue and continue and continue. And we're starting to see that with AGL. We're starting to see that obviously with Origin as well. It has been a really tough ride for these guys because, one, energy consumption has lowered because we're not out and about doing things. But also it's a political football and they don't want to let energy prices rising. So that's another issue. But it's also then that leakage. And I think that leakage is that they've talked about that regularly. It's could be around 5 to 10% of that leakage of disappearing of revenue on an annual basis because of people just being a little bit more conscious, putting solar panels on their roofs, basically just trying to use a lot less energy. So no, I think AGL's still got a long way to go to the downside. And I've been selling over the last sort of 2 weeks or so, trying to get clients out, and even at a loss, happy to buy some banks on the back of what's happened last week, potentially as a way to sort of recoup some of those losses. Yeah, and one last one. This is my curveball, but it's not a hard one. A2 Milk, bit of a downgrade today. What's your view? This is a great company, but it's a bit of a victim of the coronavirus, or what? Well, certainly a victim, yes. I was just astounded how much the Chinese visitor to Australia actually meant to A2 Milk, the Daigao or those shoppers. Yeah. I was always under the impression that was a smaller part of their business. Yep. But it looks like it has grown significantly over time, whereas, you buy A2 Milk here in the shops and things like that. But it really must have been that Chinese money that's flooded in that hasn't been able to come back into Australia. And that's probably where there's this problem that's happened. And obviously A2 Milk with a downgrade today.
Yeah.
Stock down 10%. I think it's a fantastic business. I think there's opportunity there. I'm going to wait till the dust settles on this one.
Yeah.
Give it a couple of days. It'll be in the 6 o'clock news tonight. You might see some further selling tomorrow, but let the dust settle, and then I'm a buyer of this stock. I think it's a fantastic business, good balance sheet, and the bubble is going to open up sooner than later. So it was just a concern to me that how much those Chinese visitors actually meant to the bottom line of A2 Milk. So it's a bit of a disappointment on the downgrade.
And we often see these things coming in threes, don't we, Adam? Like the report wasn't great. They talked about some corporate issues in terms of purchasing. We didn't think the Diageo or Diageo or whatever it is was all that important. It is. There may well be one other negative story, but you're right. I'm waiting for the right opportunity to get into A2 Milk. I think it's a good company.
Yeah, great. I mean, good management, good balance sheet, and a fantastic brand. So putting all of those together, it's just these blips. And if you look at a chart of sort of COVID, March 23, it actually didn't hit any lows. It stayed at $20, $19. Yeah. So it's having its fall now. So, it's catching up with the rest of the market. So I like it. I'm a buyer. I'm just going to wait a little bit longer, I think.
Okay. Adam Dawes from Xero Partners, thanks for joining us.
Thanks, Peter. Take care.
Now, Mark, your greatest competitors have always been the banks. The banks have been asked to do a lot to rescue the economy. Are the banks a bad investment now?
Well, it depends what timeline you take.
Yep.
I think if you're looking at a 5 or 10 year horizon, I think Australian banks, particularly the big four, I think they're a great investment because we're not going to get anybody else. I mean, I put Macquarie aside there. Macquarie is sort of the 5th largest. It's a bit more complex, so I can't really make a decision on that because Macquarie's got a lot of other things going on as well as the bank. But if you just look at the banks as the big four banks, over the next 5 years, they're going to own this country. I mean, they're either going to own your property if you can't make the repayments, or alternatively, if you want to get into the property market, you still got to borrow through them, or someone like us, but you still got to borrow through the banks. They do control 93% of the total market. So it's a pretty juicy bit of portfolio that they own and control. I don't expect that we're not heading into a depression. So I think that the downside liabilities of the banks is a lot lower than the upside possibilities of the banks. So I would invest in banks, yes. I don't know which one in particular. I mean, Westpac's just taken a big hit today. Depends what its share price has done. But I mean, for me, Westpac's a great bank. And I think Westpac, all right, they've done something wrong there and with Austrac, etc. But Westpac is a very good bank, has a great institutional bank inside the bank as well. They own St. George. They own a lot of other brands. To me, that's a great bank. And if its share price, if its price has gone down today, I mean, it's probably the sort of bank I'd be looking at. I mean, I really believe in our big four banks, even though I do compete against them. I do think they have a stranglehold on the economy. Yeah,
Paul Rickard agrees that Westpac is probably a buy at these levels. Now, mate, on the subject of banks and the threats, you would understand the threat of the fintech bank more than most. Are they going to eat the bank's lunch?
Well, if Google came out with a bank, if Google went and bought one of these neobanks, one of these fintechs, I'd say that would be a problem. I think the biggest issue with the fintechs is that they don't use brokers, so they don't have distribution. They can't afford to set up branches because they're a fintech anyway. But the presumption there is that borrowers will come to them to borrow money, for example, to borrow money in the event, like for a home loan. They're not going to make their money out of deposits because they're small and they're new. They've got to offer higher interest rates. So all of a sudden, their margin gets squeezed if they try and match it with an asset on the other side, that is a mortgage on the other side. So their margin is going to get squeezed because they've got to lend cheap, and they've got to take a deposit at a high rate, so their margin gets squeezed. They would argue, well, we can operate on a smaller cost of operations because we're a fintech, which is probably correct. But at the same time, I don't know whether they're going to get enough volume to be able to make a dent in the marketplace. So I hope they do. I mean, I really do think maybe between 5 and 10 years from now, the fintechs will take a bigger position. I think right now, though, and by the way, let's not kid ourselves. CBA's got some of the best technology of any of the banks.
Yep.
I mean, you can deal with CBA. You can deal with NAB through Ubank if you want to. I mean, NAB owns its own fintech. It's been around for a long time too. I mean, and if you look at and it's beautifully funded. I mean, Ubank's funded by NAB. So you've got to ask yourself the question: how come Ubank hasn't done brilliantly? It's not as if they haven't got the advertising power, they haven't got the operations power, they haven't got the technology. It's not as if any of those things. They've got massive balance sheets. They don't have to go and raise money all the time to lend it. They've got the whole NAB deposit base to lend if that's where everybody wants to go, but it's not happening that way. So my gut feeling right now is that there will remain the flight will be to quality. That is the well-known banks. People will still want to borrow from them. They still want to use a broker because it's just complex. I mean, you go online to borrow money from anybody. It's complicated. It's not easy. It's a hard thing to do, and then you're online with one lender, so you don't know whether that one lender's got the best deal in town. So brokers still will prevail, I think, which is why brokers are doing 57 to 60% of all mortgages today. And the fintechs because they're a fintech, can't afford to use a broker. So because you've got to pay a broker, and fintech's pricing is sharp. It's usually less than the rates the banks are offering. But the reason they do that is because they carve the commission out that the banks pay the broker. That's gone. It's been eliminated. But so I think there's only a small, relatively speaking, a small percentage of Australians in this who are savvy enough, who have the time, the understanding, and the credit credentials to borrow online from a neobank fintech at the moment. That's my view.
Yeah. All right, mate. Great. Thanks for joining us, Mark Bouris. You're one of the best.
See you, Pete. All the best, mate.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
So joining me now is the CEO of McPherson, a company that's done well in recent times. Let's just see what's happening with the company right now. Thanks for joining us, Laurie.
Thank you, Peter.
So Laurie, why don't you talk us through about the company? For people who've never come across you guys before, it was a company that was once in the mining space, but you're kind of in the food space now. Explain to my viewers what the company does.
Okay, yeah, it's an interesting one. So it's 160 years old, one of the first public listed companies. It started off, an old Scotsman, true to my heart, came out, set the company up, and was very much in steel, hardware, all the rivets in the Harbour Bridge, the Transcon railway, systems we put in place. But then it went through very many different industries, categories, and now we're really focused on health, wellness and beauty. The company has 450 employees. Our head office is in Sydney. We're public listed. We have a mini-me office in New Zealand, Singapore, and we have a procurement office in Hong Kong. We have about 35 full-time employees in China, mainland China. I joined the company about 3.5 years ago. Great team of people. We had a market cap about $98 million then. We've now got a market cap. I think, Peter, we closed yesterday. The market about 348, 350, something like that. The business is going well. We've got bugger all debt, which is good. We've sold a lot of that other stuff to focus on health, wellness and beauty because it's a good margin, it's progressive space, and it's growing.
Okay, so you've done well over the period of the coronavirus. Explain to my audience why.
I think it's really interesting. So our portfolio is in things such as hair care, beauty, wellness, household goods such as Multix, which was a business, Peter, we were thinking about selling, which is like cling, alpha oil and cling film and, baking paper and all the rest of it. And we did our own green version of that about 2 years ago. And all of a sudden we just went, wow. And so for this fading star, it's become quite a shining star. So that's been good for us because probably yourself, Peter, I don't know how often you're getting into the office, but most people are having, that used to have breakfast and lunch around their office facility, whether it be, in the city or North Sydney or Parramatta, CBD or whatnot. They're actually doing that at home. They're actually eating out less in the evenings. So all of our home care products have just gone bang. So that's been great. What's happened to our beauty business has been interesting because more people are online and they're still wanting to look great. I think I told you the last time we spoke, I'm 106, but my anti-aging products are really working on me.
Yeah.
So at 51 years of age, we're finding that more people are using these anti-aging products, and they're getting delivered by e-commerce and delivered to your front door on a non-contact basis.
Okay, so tell us about reporting season. What were the highlights of the season?
I think what's been really interesting is people have reverted back to. So I live in a little sleepy suburb of Mosman. I used to go to Woolies and Coles and Aldi all the time. I know our family, we go more to IGA and Metcash just because it's so local, just because it's just like, and the people in there, they all know my name. And as much as we love all those main play grocery players, we're finding that people just by behavior are shopping more local. That's really embedded. That's one behavioral change. Two, people are really into immunity and staying close to home and being a bit safer. And I think this will dissipate as this pandemic, slides hopefully to a better place. But I think people's view on local immunity, health, safety, and home is here to stay, and will probably still gather some momentum over the next 3 to 4 years. I think it will dissipate once people feel that safety again, but it's definitely a trend that we're enjoying, right?
So when I look at the chart of your share price, and I know as a CEO you're not responsible for the share price, but sometimes CEOs can explain. It was going up fantastically well. I think I interviewed you around August, and I think you gained about 10 or 12%, and then you peaked and you came off the boil. Was there any news that the market didn't like to explain why the share price came up, or was it just profit taking?
I think that's a really good question. So we closed yesterday at 306. We a year or so ago we were around $1.20 and whatnot. So we've had a pretty good run. So even though we might have came off the boil from a peak of about 314, 315, I think, we're now at 306. We came down to about 280 odd over the last couple of months and then started to build. I think there was some really, really faithful investors who just thought, you know what, I'll just put a bit in the bank. We know that some of them were mandated. And for those who haven't lived in the GFC like I have in Europe, when things go bad, people don't realize it's not only about the companies, the investors that invest in you. It's a lot about their principal companies above them, that when they start to default, it creates this situation that Australians are not really used to. And I think we just need to be careful that we need to keep an eye on who are the principal companies of your investment players on your register to make sure that they're all healthy, because if they start to default, you do get this bizarre, I worked for the Coca-Cola company for 23 and a half years. If you give a Coke, I was in the Coke company side, if you give a bottling license to a company, it's like a license to print money. But if they have investors or principals elsewhere that are defaulting, you'll find even Coke company bottlers find it hard to kind of pay the bills. So I think we've got to kind of broaden our spectrum to what could happening and what is happening with regards to not just who's investing, but who are they backed by, and who are the principals a little bit up the chain as well. Just to do a little bit of research there is going to be really important.
Yeah, so some people might have thought, well, McPherson's done brilliantly during the coronavirus period, maybe ignoring the fact that you're on an uptrend anyway beforehand, and then they might be thinking, oh, with reopening coming, well, then maybe they won't be as popular. But your argument is that you think the new things learnt during the coronavirus period will not be given up too easily. And I would have thought also Victoria... I've actually split my first half and second half. I actually think we will struggle to cycle our first half. Sorry, we'll struggle to cycle our second half. So, for example, July to December, we did pretty. January to June, we did incredibly well. So, to your point, I've kind of put in a first half relatively solid and robust, with a weaker second half, saying, Peter, I don't think I should responsibly think I can cycle the coronavirus upside we had. So things like what we call, and what the industry and the retailers call March madness, when people started buying up, I've halved that, if not even less. Yeah.
So I've not put in a big second half for us because I think it's irresponsible to our shareholders and to the company. And I actually don't believe it. But we are trending very, very well.
Acquisitions have been important to your growth story. Do you have many on the horizon?
Well, you know, I've got to be careful sort of selective disclosure, but as I told you, I've got big green lips from kissing all those frogs, and I'm kissing some nice frogs today, I must say. I'm very interested in where we're going, and in particular, I think we need to be humble because we're in a strong position. And as I said to you before, I think people are going to start hurting and are hurting, so we need to be careful not to be too opportunistic. But commercially, I still need to be opportunistic, Peter.
Yeah.
So we're probably getting more knocks on the door than before, and I think it's more of a buyer's market than before, and probably at better multiples than before. So it's looking really interesting.
What about JobKeeper? Were you a beneficiary of JobKeeper, and going forward, will you not be a beneficiary of JobKeeper?
Yeah, we're employing more people. We're growing. We have no need for JobKeeper. We pay our full taxes in Australia, at full rates across the board, 450 people. We have no JobKeeper support at all. We get no government support. We've not asked for it. We don't need it. We're going to grow our way forward. Okay,
so what's the really big things out there you're looking forward to in this? Because in case people aren't sort of recognising this, when you talk about the second half, you're talking about the second half of the financial year. What are you looking forward to in that second half?
Yeah, I think hopefully getting a couple of these deals under our belt, Peter, and hopefully being able to demonstrate some of the synergies. I think we've spoken to the street till we're blue in the face about our balance sheet being so healthy, our cash conversion, our capacity, not only for debt and equity and capital raising and people who are knocking on the door constantly with us, but also our capacity, that we're literally at 50% capacity, that literally requires no more people and no more real estate. So I've got a warehouse, 13,000 bay warehouse, that's at 54% capacity. All those 5,300 boxes that leave there every day to every pharmacy and every grocery and every postcode in Australia, for me to do an acquisition and drop something into that doesn't require any more investment. So it's incredibly profitable. So So that's what I want to see in the second half is and by the way, I probably think the second half is now looking better since we've seen that the first 3 months are so strong that we've got inherent momentum. But I do say we're going to be cycling the covert piece that I think we're just being probably a bit conservative about, which I think's probably a good thing to do.
Yeah. Well, Laurie, thanks for joining us in the program. We wish you luck, and for the sake of my viewers who liked your story a few months ago, keep on heading in the right direction, please.
Thank you again.
Well, September and October can be pretty bad for the stock market, and tech stocks have been under pressure after having a rip-roaring year so far. Paul Rickard wants to look at a couple of tech stocks he's interested in, and one of them is an American one, namely Apple. Paul?
Yeah, mate, Peter, I still think you've got to look at the technology sector. It is the best performing sector on the ASX this year, up about 22%. That was up to yesterday. Best performing sector in the US, and there are good reasons for why tech has done so well. It's not just the fact that everyone's suddenly fallen in love with tech, but it is, we know there've been some whole lot of changes in the way that consumers behave as a result of the COVID-19 crisis. And it's really accelerated a lot of change that was already in place. So some of the trends around things like cloud computing, work from home, the things about Zoom, online shopping, the internet, those trends were in place, Peter, but they've just been really given this huge impetus by what's happened. And so the revenue in that sector is not going to run away simply because we think COVID-19's over. Yeah,
and Apple is a very well-placed company. I think it peaked around $134. Do you think there's a bounce back waiting to happen, Paul?
Look, it has already bounced back. It got down to the lower hundreds. It's now back about $112. I think, look, I'm not sure I'd rush out and buy it today, but it's one I'd be marking if you do think about September, October, and I think there's a lot of good commentary about the market in the US has probably got a little bit overdone. As all markets do, we know that they go up too quickly and they come off too quickly, and you've got to wait for sometimes the pullbacks in these markets. But I think Apple around $110. Yeah, it's not excessively priced. It's trading on a PE of about 35 to 1 for this year, and
it's not big under tech standards.
It's not big under tech standards. It's not big by the likes of you think about companies like Afterpay and some of the other names in Australia that you get really to report any earnings. It's not huge. It's an incredibly strong company financially. It's sitting on a pile of cash. Stock buyback in place. I think at the right price it's a buy. So go with the market. I don't think people are going to desert Apple or Microsoft in the short term.
Yeah, you like both those companies. Let's go to the local stuff now. What are the tech stocks you like locally?
Look, the two I like in Australia are Xero. I've liked Xero for some time. It's now back almost $100, back towards its high. So maybe it's just a bit
too pricey.
Too pricey. The analysts think it's worth about $80, which is probably closer to the mark. But what I really like about Xero, Peter, is its underlying business of accounting software. It's such a sticky thing, right? You get onto that, you talk to the users, they really like it. Now it's probably grown about as far as it can in Australasia, and so it's doing things like really working on its own ecosystem. And that's a bit more challenging. The growth for a company like Xero is really got to come out of North America and the European markets. Now they say, I was surprised to read this, Peter, that clouds, most people in those markets are still using the old,
the disk,
and the software on the floppy or whatever it is, or buying the actual box.
It's a big potential.
So cloud computing is not really what in that sort of market is not like it is in Australia. So there's still a huge potential for a company like Xero offshore. Obviously, it's harder to compete in the US simply because of scale. The other one I like is NextDC, Peter, which is, look at the share price graph from NextDC, it's been going up all year. It's just data centres in Australia. Now, there's nothing sexy about that. It just does it really well. Maybe it's getting a bit on the pricey side. Analysts think it's about fair value, but I think it's one to mark down. If there is a big sell-off and you're looking for a tech company, they're the two I'd be looking to buy.
Okay, and this is your point, that these are good companies. If the market does sell off across October, these are the ones to have a good look at. Paul, before we wrap up, the banks got some surprisingly good news about responsible lending basically going to be changed, that law is going to be changed. Is this going to be a good thing for the share price?
Look, ultimately it is going to be a good thing. Two caveats. One, has got to get through the Senate, and it's not clear how Labor and the Greens will vote on this. I don't think the legislation is going to come in place till March next year. So this is not going to have any impact on current year profits. Let's be very clear about that.
Yeah.
But it is a good thing because it's been so hard to lend money, Peter. You know what it's like as a borrower, even trying to get a bank to look at stuff and the sort of questions they're asking about, why are you spending this much money on Netflix or whatever it is, and it is really tough. You talk to someone going through a mortgage process. So we've had a bit of a credit squeeze. It hasn't been widely recognised. It's sort of, so I think it's a positive thing about, particularly when banks have been challenged. The problem for banks has been how do they grow their revenue, right? And no one's come up with an answer because credit growth has been anemic. So this is a big positive in the sense that, in a year or 2 years' time, we might actually be in a position of some credit growth. Not going to impact this year's profit. So a big thing for banks. Look, I think they're probably about as cheap as they're going to get too much. I think Friday's reaction was a little bit overdone. We've seen a bit of a pullback today. But I think there is value there, at a book value. I'm not saying you're rushing to buy them just yet, but again, they're going to go with the market. Market going to be down. The banks will go as hard as anything else. And I think the big three, or put Commonwealth Bank to one side, the Westpac, ANZ and NAB are looking okay. Westpac getting rid of it's fine with Austrac is a positive. Don't worry about the size of 1.3. That's all just a one-off. Analysts will look past that. That's actually a positive to actually get that over the head. So I think that's probably, I'd still be back in Westpac. I've been on Westpac now for 6 months and largely been wrong, Peter, because it hasn't performed. I've probably been ahead of people and got it wrong, as you can in this market. But I think we're just starting to see a bit more support come into that.
Yeah. The interesting thing about responsible lending, I love the quote from a very responsible kind of guy in Dr. Phil Lowe, the Reserve Bank. He said, under responsible lending, if a borrower gets into trouble, it's always the bank's fault. And he just thought that was just a little bit unfair, and I think he's right. Paul, thanks for joining us. Paul Rickard of the Switzer Report. If you want to read about Paul's views on those tech stocks, take out a free trial of the Switzer Report, 21-day free trial.